wrap up a week shaped by the rotation out of the mega caps and into small caps, with the Nasdaq 100 falling 4% this week. The Russell 2000 higher by 1.7%. Let's bring in our market panel. Unlimited CEO Bob Elliott and Invesco Chief Global Market Strategist Kristina Hooper. It's great to have you both here, Bob. We got the Nasdaq back down, kissing 5,500. It looks like we're settling just above 5,500 here. Earnings, technicals, seasonality, politics, also geopolitics. I mean, what moves this market from here?
Well, I think what we've seen is some of the cracks that we were seeing emerging in financial market liquidity that were sort of showing their head in late June, early July, really became acute in a period where we got forced rotation caused by a short squeeze in short Russell 2000 positions held by hedge funds. And so what happened was you had a big shift in the market, not a lot of liquidity there to help contain those moves the way you would normally see. And I think overall, the big picture is the markets in aggregate, they've come down, right? Russell's outperformed, but they've come down a fair amount. That highlights the fact that this liquidity sensitivity that started to emerge a couple weeks ago, it looks like it's still there. And the trouble with that is it can be a little self-reinforcing. You know, you get a couple of these days and they create a continuous pullback from various players.
So maybe more to the shakeout here. Kristina, the fact that we have seen this rotation, and I realize maybe it's softened a little bit here in the final several days of the week, but does it have legs?
Well, I do think it does have legs because I do expect the Fed to begin cutting rates by the end of the third quarter. The big if for the sustainability of the rotation, of course, is whether or not the Fed has been able to successfully avoid a recession, or if, in fact, what it has done thus far has created so much damage for the economy. And certainly we are seeing cracks appear in the consumer, but nothing at the level that would suggest that we are going to see any kind of imminent recession. So my base case is that this is sustainable because we will see rate cuts and we will see an economic reacceleration coming in future months.
Okay. Now, Bob, looking now at the medium to long term as investors try to figure out what to do with their portfolios and maybe the impact of some of this political, the RNC was this week, and we heard a lot of things. We've heard about higher tariffs. We've heard about now a weak dollar from J.D. Vance as being some kind of a goal, and also a flat tax. All things that sound blue collar, but some of those things are in conflict with each other.
Yeah, in particular, I think the currency-related policy is a bit confusing in the sense of the implication of adding significant tariffs, which should be both supportive to the U.S. economy and also inflationary, are also supportive to the dollar by reducing our reliance on foreign imports. So that's a positive to the dollar. And then on the other side, talking about how the dollar should fall as a policy goal. I think the challenge for any policymaker in the U.S. government is currencies are notoriously difficult to control. So their policy that is much more probabilistic is that implementation of tariffs, which would be supportive to the dollar, supportive to U.S. growth and investment, but also inflationary. And so when you talk about that sort of medium to longer term, you know, as we turn to 2025 and start looking there, are we going to be able to see this persistent disinflation, a soft landing in an environment where inflationary political policies are being pursued by possibly a new administration?
Interesting. Okay, so Kristina, if you're thinking about either dollar strength or the puts and takes around international stock investment, should you be thinking at all about how you expect this election to turn out at this point, or is it a fool's errand to make guesses on policy?
I would choose the latter. I think it's a fool's errand. If you think about the time horizon on an election, it's much shorter than the time horizon on most investors' portfolios. So, and of course, there's also the added component to this, which is that sometimes policies don't have the results one would expect, especially the impact on markets. So I would argue monetary policy matters a heck of a lot more than who is elected in November. And so that means focusing on what the Fed is going to do. And I think the Fed will, in fact, begin cutting rates, and that will cause a weakening of the U.S. dollar, at least a modest weakening. So a policy goal that might be stated by a candidate would be much more likely to be realized by the Fed.